Robinhood, ticker symbol HOOD, has been absolutely crushed in the recent months. It IPO'd in late July 2021 at $38 a share, giving it a market cap of a staggering $32 billion. After that, it quickly hit an all-time high of $85 a share within just a few days of trading. But after that, it's all been downhill. The company's price history looks atrocious. It's a constant decline with no end in sight. As of June 17, 2022, Robinhood is trading at $7.18 a share, giving it a market cap of only $6.25 billion, a more than 80% decline from its IPO price. The sentiment on the stock is not great either. It's very much hated on forums like Reddit, where a large amount of people believe that Robinhood colluded with Citadel to stop the GameStop and AMC short squeeze. Analysts have also been quick to dismiss the stock entirely and downgrade it. Everyone seems to hate the stock, and that's what prompted me to take a closer look. In the stock market, the best returns are often made when everyone is utterly convinced of something that turns out to be false. After analyzing the stock, I have come to the conclusion that Robinhood is far from being trash. But before I lay out all the reasons why I think so, I will first go over all the negatives. The popular narrative has four major headwinds for Robinhood. 1. The current bear market. It's expected that retail traders will significantly reduce their trading activity during the bear market. 2. They ruined their reputation last year during the GameStop and AMC debacle. 3. The SEC will ban or regulate payment for order flow, Robinhood's primary business model. 4. They are burning through cash rapidly and will go bankrupt soon. Now let's go over these in detail and explain why they won't matter. There is just no getting around it. The bear market will significantly hurt Robinhood. Already, we can see that their transaction-based revenue has dropped from $420 million last year to just $218 million this year, almost a 50% decrease, and their monthly active users have dropped to 15.9 million compared to 17.17 million last year. And worst of all, the average revenue per user has dropped to just $53 compared to $137 last year. As bad as it is, it's expected to get even worse as the bear market continues or even intensifies. This is not a problem that you can overlook, but there are still 23 million funded accounts on Robinhood, and the average revenue per user is expected to go back up once the bear market is over and we enter the next bull cycle. Okay, what about the fact that they ruined their reputation during the GameStop short squeeze? Surely that will hurt them. Alright, let's take a step back and look at what really happened and what the accusations are. Many people believe that during the 2021 GameStop short squeeze, Robinhood purposefully turned off the ability for their users to buy GameStop shares to help their biggest client, Citadel, who had an investment in Melvin Capital, a hedge fund that was shorting GameStop. This is almost certainly a conspiracy theory without any merit, and it overlooks the fact that most brokers also shut down buying, and the reason for it was to meet their collateral obligations with DTC, a clearinghouse. The fact that I'm acquitting Robinhood of doing any wrongdoing might rub a lot of people the wrong way, but keep in mind, I was actually one of the people who profited massively from the short squeeze. The squeeze would not have been possible without brokerages like Robinhood enabling a massive amount of retail traders to participate in the markets easily enough to move them. Another problem that Robinhood faces is that the SEC is looking into regulating payment for order flow or even banning it outright. Payment for order flow is actually banned in most of the world, so it would not be very unusual. This is definitely a problem for Robinhood, but I do believe they will think of other ways to monetize their service, and even if they can't, for reasons you'll see later on in the video, this ultimately will not matter at all. And last is the problem of their cash burn. Robinhood burned $392 million in the last quarter, and $423 million the quarter before that. This is terrible, but fortunately, they're already reducing their burn by quite a significant amount. They already laid off 9% of their workforce, and I expect many more layoffs in the coming months. They are also reducing their marketing and scaling back all the expenses they took in order to grow very fast. With all the austerity measures, they may be able to get their burn down to as low as $200 million a quarter. And while that's still terrible, keep in mind that Robinhood has $6.3 billion of cash and $7.1 billion of net assets. They can keep this going for a long time. Now that we have gone over all the reasons why Robinhood seems like a terrible investment, let's figure out why they really aren't. First, Robinhood has more than $7 billion in net assets, and $6.3 billion of that is actually cash. Their market cap right now is $6.25 billion, so they're trading under book value. If someone could just outright buy the entire company at the current market cap, they would actually end up with more cash than they started with. All those assets, they're not just sitting there, they're actually earning interest for Robinhood. Just last quarter, they made $55 million just from interest. That comes out to $220 million every year, but with interest rates going up sharply, we can expect that amount to increase several fold. And now for the biggest reason why I'm so bullish on Robinhood. Robinhood is an excellent acquisition target for other bigger brokers like Schwab, Vanguard, or Interactive Brokers. Robinhood has 22.8 million funded accounts with an average holding of $4,000 to $5,000. While that seems very low, Robinhood's user base is very young, and they are expected to significantly increase their net worth in the coming decades. If an established broker like Schwab could scoop in and get Robinhood and pocket those 23 million users, they would be able to funnel those users into their own platform as their net worths increased in the coming years. So Robinhood, with its 23 million young users, is a tremendous value for any big broker if they think long term. This was made even more clear last month when Sam Bankman-Fried, the founder of one of the biggest cryptocurrency exchanges, FTX, revealed a 7.6% stake in Robinhood. Clearly, I'm not the only one who sees the potential in Robinhood's young user base. The founder of FTX seems to have the same view. What's more, because of Robinhood's massive cash reserves, any one of these big players can purchase Robinhood for a very cheap price. If they make an offer for, let's say, $10 billion, a 70% premium from the current trading stock price, after acquiring Robinhood and deducting all the net assets and cash, they will have only paid $3 billion. $3 billion to acquire Robinhood's 23 million users and have the biggest financial brand among the younger demographic. That is a steal. But what if no one ends up acquiring them? After all, you never want to invest in a company that is completely dependent on an external third party. So my last point will address this. Even if Robinhood is not acquired, I still believe they will survive and thrive on their own. First, remember, they have $7.1 billion of net assets, and about 90% of that is cash. They're also reducing their cash burn in a hurry. There is no doubt in my mind that Robinhood will have the funds to sustain themselves for the next several years and stick around until the bear market gives way to the next bull cycle. And when that does happen, Robinhood will be the premier brokerage for the younger demographic. With their very easy to use interface and gamified experience, they will always remain a hit among the financial newbies, as well as pulling their current users back to the platform. Robinhood also has innovation in its blood. Not only did they popularize commission-free trading, they also introduced fractional shares, options trading, and now IPO allocation to the retail masses. No other company has been able to match their pace of innovation in the financial sphere. There is no reason to doubt Robinhood will stop now. Just think about the impact Robinhood has had on the financial markets in just the last 5 years. There are types of companies that don't just exist to squeeze profits out of the current paradigm. They exist to shake up the status quo and make their own market. In finance, where innovation is almost non-existent, Robinhood stands alone. So, should you buy Robinhood stock? First of all, nothing in this video is financial advice for others. It is simply my opinions on Robinhood as the company. I will not tell anyone to buy or sell for two reasons. One, I am not certified to do that kind of thing. Two, I do not know the circumstances of other people and what their goals are for investing or trading. Giving advice in a vacuum never works out. Instead, I will lay out what my plans are. Right now, I plan to just wait on the sidelines. I will watch the price action of Hood stock and the S&P 500. If either of them seem to have bottomed out and is making a sustained rally for a couple of months, I will consider buying after analyzing the then valuation to see if it remains a good opportunity. Yes, I'll miss out on the bottom, but my investment strategy is to never time the market exactly. That is impossible. I seek to simply ride the trends for 90% of their existence and stop worrying about buying the exact bottom or selling the exact top.